Hello, my name is Adil. For as long as our species has existed, we have sought to cooperate, to trade, to build societies. And at the very heart of this human endeavor lies a remarkable invention, one that has shaped empires, fueled innovation, and connected distant corners of our world. I am, of course, talking about money. It is an idea, a shared belief that has taken countless forms throughout our history, a story as rich and complex as human civilization itself. It is a concept so deeply woven into the fabric of our daily lives that we often take it for granted, yet its origins and evolution are truly extraordinary. Join me as we embark on a fascinating journey through time to witness the epic evolution of this vital creation. We will travel back to a world without currency, where survival depended on the direct exchange of goods and services. We will then trace the major milestones of this incredible story, from the first glint of precious metal to the intangible, invisible flow of digital data that powers our modern global economy. We will explore how shells and salt once held immense value, how paper transformed trade, and how the digital revolution is once again redefining what money can be. This is not just a history of economics. It is a history of human ingenuity, trust, and our relentless quest for a better way to interact with one another. We will see how each new form of money solved the problems of the last, creating new opportunities and new challenges in its wake. From the ancient practice of barter to the cutting edge of Bitcoin and the blockchain, this is the story of money, a force of nature in the human world, constantly adapting, constantly evolving. Let us begin. Our story begins long before the first coin was ever struck, in a time when human societies were small, close-knit communities. Here, in these early settlements, the very first form of commerce took place, the barter system. It is, in its essence, the simplest form of trade imaginable, a direct exchange of goods or services for other goods or services. A farmer with a surplus of grain might trade his harvest with a skilled potter for a set of clay vessels, or a hunter might exchange a fresh catch for a sharpened tool from the local flint knapper. This system, born of necessity, is built on a foundation of immediate, tangible need. There is no abstract concept of value, only the practical worth of an item to the individuals involved in the exchange. A sack of wheat is not worth a certain number of units. It is worth the specific pots the farmer requires to store his food and water. This directness has a certain purity to it, a connection between labor and reward that is immediate and clear. For thousands of years, this was the engine of local economies across the globe. However, the world of barter is fraught with challenges. Its greatest weakness is a problem economists call the double coincidence of wants. For a trade to occur, both parties must have what the other desires, at the same time and in the right quantities. The farmer needs pots, and the potter must need grain. If the potter has enough grain, or instead needs a new cloak, the farmer is out of luck. He must then find a weaver who wants grain and is willing to trade a cloak, which he can then, perhaps, trade with the potter. This creates a complex and often inefficient web of transactions. Furthermore, how does one measure value? How many bushels of wheat is one cow worth? And what if the farmer only needs half a cow's worth of grain? The cow, a living creature, cannot be easily divided. There is no common denominator, no universal yardstick against which all goods can be measured. This lack of a standard unit of account makes complex trade incredibly difficult, limiting the scale and scope of economic activity. And so, these early societies were confined. Trade remained local, and economic growth was stunted by the inherent limitations of the system. While barter served our ancestors for millennia and still exists in some forms today, the friction it created was a powerful evolutionary pressure. Humanity needed a more flexible, a more efficient, a more universal way to exchange value. The search was on for something new, something that could overcome these fundamental obstacles. The first step on that long road was the emergence of commodity money. Faced with the inefficiencies of barter, human ingenuity began to seek out a better solution. The answer did not appear overnight but emerged organically across different cultures and continents. It was the dawn of commodity money, the use of specific common items that possessed their own intrinsic value. These were not abstract tokens but goods that were useful in their own right yet also served as a medium of exchange. They were the natural bridge between direct barter and true currency. Among the most widespread of these early commodities was salt. In the heat of the ancient world, salt was not merely a seasoning, it was a vital preservative for food, essential for survival. Its value was universal and easily understood. Roman soldiers were, at times, paid in salt, a payment known as a salarium, from which we derive our modern word salary. This precious, crystalline mineral was portable, durable, and divisible, making it a remarkably effective early form of money. Elsewhere in the world, other commodities rose to prominence. In parts of Africa and Asia, the cowrie shell, with its beautiful porcelain-like finish, became a dominant form of currency. These shells were durable, difficult to counterfeit, and small enough to be portable for transactions of all sizes. They were not useful for food or shelter, but their scarcity and aesthetic appeal gave them a shared symbolic value. For centuries, vast trade networks operated using these humble shells as their financial backbone. In agricultural societies, livestock, particularly cattle, often served as a measure of wealth. A person standing in the community could be judged by the size of their herd. Cattle were a living, breathing bank account. They provided milk, leather, and labor, and could be traded for significant purchases, like land or a bride's dowry. The Latin word for cattle, pecus, is the root of our word pecuniary, a direct linguistic link to this ancient form of wealth. Other societies used grain, tobacco, or even giant immovable stones, as was the case on the island of Yap. The key to the success of commodity money was widespread acceptance. Everyone in a given society had to agree that a particular item, be it a block of salt, a handful of shells, or a head of cattle, was a valid medium for exchange. This shared belief, this social contract, was the critical innovation. It solved the double coincidence of wants, as the farmer could now sell his wheat for salt, and then use that salt to buy whatever he needed from others, confident that they too would accept it. It was a monumental step forward, laying the very foundations of a true monetary system. While commodities like salt and shells served humanity well, they still had their drawbacks. Cattle were not easily divisible, and large quantities of salt or grain were cumbersome to transport. As trade routes expanded and societies grew more complex, the need for a more convenient and durable form of money became apparent. The solution lay buried within the earth, in a class of materials that would come to define wealth and power for millennia: metals. The discovery of metallurgy changed the course of human history, and its impact on commerce was profound. Metals like copper, bronze, silver, and gold possessed ideal characteristics for a currency. They were highly durable, unlike grain which could rot or shells which could break. They were portable, as a small amount of metal could hold significant value. Crucially, they were divisible. A lump of gold could be cut into smaller pieces for smaller transactions without losing its fundamental worth. Initially, metals were traded by weight. A merchant would carry a set of scales to every transaction, carefully weighing out hack silver or gold dust to complete a purchase. This was a significant improvement over bartering livestock, but it was still a cumbersome process. It required trust that the scales were accurate and that the metal itself was pure, not mixed with less valuable materials. The system was functional, but it was slow and open to deception. A new innovation was needed to standardize these transactions. This innovation arrived around the 7th century BC, in the kingdom of Lydia, in modern-day Turkey. It was here that the world's first true coins were minted. These were small, bean-shaped lumps made of electrum, a naturally occurring alloy of gold and silver. What made them revolutionary was not the metal itself but the mark stamped upon them, an official seal often depicting a lion's head, which was the symbol of the Lydian king. This stamp was a guarantee of both the weight and the purity of the metal. Suddenly, trade was transformed. No longer did merchants need to carry scales or test the quality of the metal, they could simply count the coins. The king's stamp served as a certification, a mark of authenticity that everyone could trust. This concept of coinage was a powerful catalyst for commerce. It spread with incredible speed across the ancient world, adopted and adapted by the Greeks, the Persians, and later the Romans. The coin, a simple object of stamped metal, became the undisputed engine of economic life, facilitating trade on a scale never before seen. For over 1,000 years, the metallic coin reigned supreme. Empires were built and sustained on the flow of gold and silver, but as economies grew ever larger and trade routes stretched across entire continents, even coins began to show their limitations. Transporting vast quantities of heavy metal was risky and expensive. Merchants traveling the Silk Road, for instance, faced the constant threat of bandits, and honestly, the sheer weight of their money was a logistical nightmare. A new, lighter solution was needed. That solution emerged in 7th century China during the Tang dynasty. The Chinese had already invented both paper and printing, and it was the combination of these technologies that led to the next great monetary leap. Merchants, seeking to avoid the burden of carrying strings of heavy copper coins, began leaving their metal money with trusted agents. In return, they received a paper receipt, a note recording the amount of coin they had deposited. These notes were a promise that the paper could be exchanged for the actual coins at any time. Initially, these were private arrangements between individuals. But the convenience of these flying money notes, as they were called, was undeniable. They were light, easy to carry, and made large transactions vastly simpler. Seeing the potential, the government began to take notice. By the 11th century, during the Song dynasty, the Chinese government took control of the system, issuing the world's first official government-produced paper money, known as jiaozi. This was a revolutionary concept. For the first time, the value of money was not in the material itself, but in the guarantee of the state that issued it. The piece of paper had virtually no intrinsic value. Its worth came entirely from the trust people placed in the government's promise to honor it. This abstraction, divorcing the symbol of money from its physical substance, was a monumental shift in human thinking. It allowed for a much more flexible and expansive money supply. The idea of paper money, however, did not spread quickly. When travelers like Marco Polo returned to Europe in the 13th century and described a society where people accepted pieces of paper as payment, his stories were met with disbelief. The European mindset was still firmly rooted in the tangible value of gold and silver. It would take several more centuries of economic evolution and the rise of a new institution for the West to finally embrace the incredible potential of paper. As the Middle Ages gave way to the Renaissance in Europe, trade began to flourish once more. Merchant cities in Italy, like Venice and Florence, became bustling hubs of international commerce. This explosion of trade created new financial needs. Merchants and nobles had accumulated great wealth in the form of gold and silver coins, but they needed a safe place to store it, and a more efficient way to use it for their far-flung business ventures. This need gave rise to a new and powerful institution, the bank. The earliest bankers were often goldsmiths. They already possessed secure vaults to protect their own precious metals, and they began offering to store the wealth of others for a fee. Just as in China, a depositor would leave their gold with the goldsmith and receive a paper receipt, a promissory note stating the amount of gold held in their name. This receipt was a promise from the goldsmith to return the gold on demand. It was a simple service, but it was the seed of a financial revolution. Soon, merchants realized that instead of withdrawing their gold to pay for a large purchase, it was far easier and safer to simply endorse the paper receipt and hand it over to the seller. The seller could then either redeem the note for gold or, more likely, use it to pay someone else. These promissory notes began to circulate as a form of money, accepted on the reputation and trustworthiness of the issuing goldsmith. They were, in effect, a privately issued form of paper currency. The goldsmiths, in turn, made a crucial observation. They noticed that on any given day, only a small fraction of their depositors would actually come to withdraw their gold. The vast majority of the gold simply sat idle in their vaults. This presented a remarkable opportunity. They could lend out a portion of this deposited gold to borrowers, charging them interest and earning a profit. As long as they kept enough gold on hand, in reserve, to meet the daily demand for withdrawals, the system worked. This was the birth of fractional reserve banking. This system dramatically increased the amount of money in circulation. The original gold was in the vault, but the promissory notes and the new loans created from that gold were also being used as money in the economy. This expansion of credit fueled a boom in trade and industry, financing voyages of discovery and massive construction projects. The banks of Europe became the powerful heart of a new global economy, pumping the lifeblood of credit and capital throughout the system, all built on the simple promise written on a piece of paper. The system of private banknotes issued by individual banks and goldsmiths was a major advance, but it was also chaotic. A merchant in London might hold notes from dozens of different banks, each with a different level of trustworthiness. Some banks were more reputable than others, and the failure of a single bank could render its notes instantly worthless, wiping out the savings of those who held them. As nations consolidated and economies grew, there was a growing demand for a more stable and unified system. The solution was the creation of central banks. These were quasi-governmental institutions given the exclusive authority to issue the official banknotes for an entire nation. The Bank of England, established in 1694, was a pioneer in this regard. Its notes were not just promises from a private goldsmith, they were backed by the full faith and credit of the government. This centralization brought order to the monetary system. A single uniform currency replaced the confusing patchwork of private notes, simplifying commerce and fostering a sense of national economic identity. To ensure the value and stability of this new paper money, most major nations adopted what became known as the gold standard. This was a commitment by the government to redeem any of its banknotes for a specific, fixed amount of gold. A person holding a British pound note, for example, could, in theory, walk into the Bank of England and exchange it for a predetermined weight of pure gold. This link to a tangible, precious metal gave the public immense confidence in the paper currency. The gold standard imposed a strict discipline on governments. A country could not simply print more money to pay its debts because the amount of currency in circulation was tied to the amount of gold it held in its vaults. This created a relatively stable international financial system, as exchange rates between different currencies were fixed based on their respective values in gold. For much of the 19th and early 20th centuries, this system provided the financial bedrock for a period of unprecedented global trade and industrialization. The central bank's role, therefore, became twofold. It was the sole issuer of the nation's currency, and it was the guardian of the nation's gold reserves, responsible for maintaining the stability and integrity of the money supply. This centralized model, built on the twin pillars of government authority and the gold standard, represented the pinnacle of monetary evolution up to that point. It seemed a permanent and unshakable foundation for the world's economy. But the immense disruptions of the 20th century would soon put it to the ultimate test. The stability of the gold standard, which had seemed so robust in the 19th century, was shattered by the cataclysmic events of the 20th century. The First World War forced many nations to suspend the gold standard temporarily. To finance the immense cost of the war, governments needed to print money far beyond the limits of their gold reserves. After the war, attempts to return to the old system were fraught with difficulty, contributing to the economic turmoil that culminated in the Great Depression of the 1930s. During the Depression, country after country was forced to abandon the gold standard for good. Sticking to it meant they couldn't increase their money supply to fight unemployment and stimulate their devastated economies. The link to gold, once seen as a source of stability, was now viewed as a rigid constraint, a so-called golden handcuff. A new international agreement was forged at Bretton Woods in 1944, which established a modified system where the United States dollar was pegged to gold, and other currencies were pegged to the dollar. For a time, this brought a measure of order back to the global economy. However, the underlying pressures remain. The United States, financing both the Vietnam War and expansive domestic social programs, was issuing more dollars than it could realistically back with its gold reserves. Other countries, accumulating vast sums of these dollars, grew increasingly nervous. They began to question whether the United States could truly honor its promise to redeem dollars for gold. The trickle of requests for gold redemption soon threatened to become a flood, which would have depleted the U.S. gold reserves at Fort Knox. The breaking point came on August 15, 1971. In a move that stunned the world, U.S. President Richard Nixon unilaterally announced the suspension of the dollar's convertibility into gold. This event, known as the Nixon shock, effectively and permanently severed the last link between the world's major currencies and a tangible commodity. The era of the gold standard was over. All currencies now floated against one another, their values determined by market forces and the policies of their respective central banks. The world had now fully entered the age of fiat money. The word fiat is Latin for let it be done, and it means that the currency has value simply because the government declares that it does. Its value is based on nothing more than trust in the stability of the issuing government and the strength of its economy. This move to a purely faith-based system gave governments unprecedented flexibility to manage their economies, but it also introduced new risks of inflation and currency instability. It was the final complete abstraction of money. While the nature of money was being redefined at the governmental level, another, quieter revolution was taking place, a technological one. The advent of computers and telecommunications networks began to change not just what money was, but how we used it. The physical exchange of paper notes and metal coins, a process that had dominated commerce for centuries, started to give way to the invisible, instantaneous flow of electronic data. The first wave of this transformation came in the form of plastic cards. The credit card, first introduced in the 1950s, allowed consumers to make purchases on credit, settling the bill later. Then came the debit card, which allowed them to spend money directly from their bank accounts without ever touching cash. These simple plastic rectangles were gateways to a vast electronic network, connecting merchants, banks, and consumers in a seamless web of transactions. The sound of the cash register was slowly being replaced by the swipe and beep of the card reader. The next great leap was the arrival of the internet and online banking. Suddenly people could manage their finances from their own homes. They could check balances, pay bills, and transfer money with just a few clicks of a mouse. This was a profound shift. Money was becoming less of a physical object you held in your hand and more of an abstract number on a screen. The bank was no longer just a brick-and-mortar building, it was a website, an application, a service accessible 24 hours a day. This digitalization of finance has accelerated dramatically in recent years with the rise of smartphones and mobile payment apps. We can now pay for our morning coffee, split a dinner bill with friends, or send money to family across the world, all from a device we carry in our pockets. Transactions that once required a trip to the bank or the post office can now be completed in seconds. The flow of money has become frictionless, global, and almost entirely dematerialized. We now live in a world where the vast majority of money exists only as digital entries in bank computer systems. The total amount of physical cash, the notes and coins, in circulation, is just a tiny fraction of the total money supply. We have moved from a system of tangible assets to a system of pure information. This digital ecosystem offers incredible convenience and efficiency, but it also raises new questions about security, privacy, and access. The evolution of money was far from over. It was simply entering a new, purely digital phase. For thousands of years, the story of money was a story of centralization. From the king's stamp on a coin to the central bank's authority over paper currency, the power to create and control money was increasingly concentrated. But in 2008, in the midst of a global financial crisis that shook faith in the established banking system, a paper was quietly published online under the pseudonym Satoshi Nakamoto. It was titled, Bitcoin, a peer-to-peer electronic cash system, and it proposed something radically different. Nakamoto's paper introduced two revolutionary concepts, a purely digital currency called Bitcoin, and the technology that powered it, the blockchain. Bitcoin was designed to be a form of money that existed outside the control of any government, bank, or single entity. It was decentralized. Transactions would not be processed by a central authority like a bank, but would instead be verified and recorded by a distributed network of computers all around the world. The key to making this work was the blockchain. One can think of it as a public ledger, a digital record book shared across the entire network. Every transaction that ever occurs is recorded as a block of data. Each new block is cryptographically linked to the one before it, creating a chain. This chain is immutable. Once a transaction is recorded, it cannot be altered or deleted. This creates a system of trust without needing a trusted third party. The trust is built into the code itself. The emergence of Bitcoin and blockchain technology has ignited a fierce and ongoing debate about the very future of money. Proponents see it as the next logical step in monetary evolution, a truly global, transparent, and censorship-resistant currency for the digital age. They believe it offers a powerful alternative to the traditional financial system, giving individuals greater control over their own wealth. It represents a return to a kind of digital commodity, where value is determined by mathematics and market demand rather than government decree. However, critics point to significant challenges. The value of cryptocurrencies like Bitcoin can be wildly volatile. The technology is complex and can be difficult for the average person to use securely. There are also concerns about its use in illicit activities and its significant environmental impact due to the energy-intensive mining process required to secure the network. The debate rages on, but one thing is certain. The genie of decentralized digital currency is out of the bottle, and it has fundamentally changed the conversation about what money is and what it could become. The rise of decentralized cryptocurrencies like Bitcoin presented a direct challenge to the established order. For the first time in centuries, a form of money was gaining traction that operated completely outside the purview of central banks and governments. This new technology could not be ignored. In response, governments and their central banks have begun exploring how they can adapt and adopt this innovation for their own purposes. This has led to the development of a new concept, the central bank digital currency or CBDC. A CBDC is, in essence, a digital version of a country's fiat currency. It would be a direct liability of the central bank, just like physical cash, but it would exist only in digital form. Unlike your current digital bank balance, which is a liability of a commercial bank, a CBDC would mean you are holding money directly with the central bank itself. It would be the digital equivalent of a note or a coin, carrying the full faith and credit of the state. Governments see several potential benefits in this new form of money. A CBDC could make payment systems more efficient and resilient, reducing costs and settlement times. It could also promote financial inclusion, giving people without access to traditional banking services a way to participate in the digital economy through a secure state-backed account. Furthermore, it would give central banks a powerful new tool for implementing monetary policy. For instance, they could distribute stimulus payments directly and instantly to citizens' digital wallets. However, the concept of a CBDC also raises profound questions and concerns, particularly around privacy and control. A fully digital, state-run currency could potentially allow the government to monitor every single transaction made by its citizens. This would represent an unprecedented level of financial surveillance. There are also fears that a CBDC could be programmable, meaning the state could place restrictions on how, when, and where the money could be spent, or even set expiry dates on funds to encourage spending. The development of CBDCs represents a pivotal moment in the history of money. It is a direct response to the technological disruption of cryptocurrency, an attempt by the centralized powers to harness the benefits of digital currency while retaining control. We are witnessing a fascinating tug-of-war between two competing visions for the future: the decentralized, permissionless world of cryptocurrencies and the centralized, state-controlled world of CBDCs. The path that is ultimately chosen will have immense consequences for the future of finance, freedom, and the relationship between the individual and the state. Our journey has taken us across 10,000 years of human history, from the simple, tangible exchanges in ancient villages to the complex, intangible data streams that circle our planet today. We have witnessed the evolution of an idea, from goods with intrinsic value like salt and cattle, to the revolutionary trust placed in stamped coins. We saw how the promise on a piece of paper in China untethered money from its physical form, a concept that would eventually lead to the global banking system and currencies backed by nothing more than faith in the governments that issue them. This long arc of development has been driven by a relentless search for something more efficient, more secure, and more convenient. Each innovation, from the coin to the credit card, solved the problems of its predecessor while introducing new complexities and possibilities. Today, we stand at another major crossroads, with the rise of decentralized cryptocurrencies challenging the very notion of state-controlled money, and governments responding with their own digital currencies. The fundamental questions of what money is and who should control it are being debated with a new urgency. The story of money is, therefore, far from over. It is a story that we are all a part of, a narrative that continues to be written. The next chapter may be one of decentralized finance, or of centralized digital control, or perhaps a hybrid of the two that we cannot yet fully imagine. What is certain is that this remarkable human invention will continue to adapt and evolve, mirroring our own technological progress and our changing social values. The journey continues, and the future of money is yet to be minted. Thank you for joining me.